Welcome to Questioning the Manager. Today I'm joined by Ben Lofthouse, Fund Manager for Henderson International Income Trust. Thank you for joining us, Ben. 2017 saw global equity markets pay a record amount of dividends in the region of $1.25 trillion. What were the drivers behind this, and are we likely to see 2018 pay a similar amount?
Yeah, 2017 was a great year globally for dividends. What we saw was, I'd say, three kind of overarching themes. One, we've seen a synchronized global recovery. So for the first time in many years, we've had all the major economies, including China and the US and the European region, growing together. And growth is good for dividend growth. So when earnings are growing, dividends tend to grow. And then on top of that, we have seen a rebound in commodity prices. And so particularly for certain countries, the UK being one of them, markets like Australia and some of the emerging markets being others, there's a lot of mining companies and oil companies, so a higher price year on year has allowed them, given them more confidence to pay dividends and in some case reinstate dividends. And finally, I'd say there's been some clarity on financial regulation, both in the US and in other markets around the world like Europe. We've had some clarification on what some quite technical factors, I won't go into them now, but that suggest banks know what capital requirements they have, and that makes those who have the ability to pay dividends are free to pay dividends. So we saw quite a lot of growth from the financial services sector. And these things were mirrored within the Henderson International Income Trust portfolio. So we saw particularly good growth from financials and also particularly good growth from some technology. So we're seeing some very good growth in technology, very strong balance sheets, and that's been a strong area as well.
Looking at the HIMP portfolio, how are you positioning the trust to deliver shareholders with a high income? Are you changing the mix in terms of geography or sector?
Yeah, so in terms of income, we're very comfortable at the moment for the portfolio. It's a very diverse portfolio. So some of our biggest weightings are things like financial services, but we own lots of different financial services around the world. So that reduces some of the regulatory risk of changes there. We own quite a bit of technology. So what we're seeing is technology adoption is growing, and we're seeing a big surge in demand for equipment, particularly in terms of semiconductor chips and memory. And so we're seeing companies there that have very strong balance sheets already are increasing their dividends. So I think what we're finding is that we're finding a lot of diverse areas that are growing dividends. What I think we're trying to avoid are those areas where there's a lot of leverage that's built up, so a lot of debt. We have seen, because rates are low, interest rates are low, quite a few businesses have been able to take advantage of that to take on more debt. And I guess we're just a little bit cautious that those businesses might not be as secure through a downturn. So we have reduced some of our real estate. We don't have a very high weighting in utilities. And I guess over the year we have reduced some of our weighting in some of the areas like telecommunications. Not that they're particularly worried, but they're not growing a lot and the dividends aren't growing a lot there.
The market seems to be more convinced that interest rates are going up. How might this impact equity markets, and what, if anything, are you doing in response to this? Yeah,
so the interest rate question is one that comes up more now. Definitely this year in January, February, there was some data from the US that led people to believe interest rates would be going up more quickly than they expected, and there was more inflation. We've been expecting some sort of a surprise like this for a while, just because inflation rates, the expectations for it have been so low, and interest rates in many countries are still very low. So it hasn't been a surprise for us, and in preparation for that, we reduced some of the areas that traditionally don't perform as well when interest rates start to go up. So we don't own very many utilities. We have reduced exposure to real estate, and we have reduced exposure to areas like telecommunications, and we have quite a lightweight in consumer staples. So these are traditionally areas, they don't necessarily fall, although they have done recently, but they quite often underperform a market when interest rate expectations are higher. I would say, I don't know if we see a lot of movement in interest rates. So I would say, across most of Europe, Japan, large parts of the world, interest rates are still very, very low and have shown no sign of going up. So, I think we find different regions, the likelihood of interest rates increases are higher than in others, and it's not something necessarily that we worry about across the whole portfolio.
Ben Lofthouse, thank you for your time.
Thank you very much.